Record. All right. So just made myself a new setup, and this should be way better to record these. But there's some new news in. We got the spot Bitcoin ETF application by ARK and 21 shares rejected by the SEC again. So in a move that comes as little surprise to those familiar with regulatory landscape surrounding the fleeting crypto industry, the U.S. Securities and Exchange Commission has once again denied an application from ARK Investment Management and 21 shares to list a spot Bitcoin exchange traded fund on the BZX exchange, the SIBO BTX exchange. So I think this is like the third time getting rejected by the SEC. So that's so dumb. I don't know what needs to happen, but something needs to happen. Oh, second time, yeah. This marks the second time that the much feared regulator has shot down the proposal, with a similar effort being previously rejected in April. Underrated duo, the submitted underrate. Oh my God. Undeterred, the duo submitted a new application last May, but the agency once again cited concerns over fraud and manipulation as a primary reason for this decision. The SEC highlighted that that BZX had failed to demonstrate that its proposal was consistent with the requirements surrounding the prevention of malevolent practices. The agency's decision is based on its belief that the Bitcoin market is still susceptible to fraud and manipulation, and that a comprehensive surveillance sharing agreement with a regulated market of significant size is needed in order to detect and deter such practices. Okay. Well, yeah, that would be good, but you're not regulating it. Now you're just blocking the ETF. Okay. The SEC argues that BZX has failed to address risk factors that are specific to Bitcoin. It remains to be seen whether ARK and 21 shares will make another attempt to list a spot Bitcoin ETF, but in the current regulatory climate, it seems unlikely that the SEC will change its stance on the matter anytime soon. So yeah, that's about ARK. And here's why Bitcoin price could correct after the US government resolves the debt limit impulse. For much of 2022, the crypto market focused on the US Federal Reserve's actions. The central bank created a bearish environment for all risk on assets like stocks and cryptocurrencies by increasing the interest rates on borrowing. Towards the end of 2022, positive economic data, health employment numbers, and a decreasing inflation rate provided hope that a much awaited slowdown in the rate of interest rate hikes would occur. Currently, the market expects that the rate hikes to reduce from 50 basis points to 25 basis points before the complete end of the hike regime by mid 2023. From the perspective of the Fed's goal of constraining liquidity and providing headwinds to overheated economy and stock market, things are starting to improve. It appears that the Fed's plan of a soft landing by quantitative tightening to curb inflation without throwing the economy into a deep recession might be working. The recent rally in stock markets and Bitcoin can be attributed to the market's trust in the above narrative. However, another essential American agency in however, and okay, let me just say what I was going to say about this. Well, uh, the stock market was down so much, so it's only up just because it was down so much, really, if you think about it. And I don't think it really shows much trust, because even if they don't trust, I mean, if the if the market crashes, they're just going to keep printing money. So either way it goes, I mean, you're pretty safe investing in the markets, but whatever. However, another essential American agency the US Treasury poses significant risks to the global economy. While the Fed has been draining liquidity from the markets, the Treasury provided a countermeasure by draining its cash balance and negating some of the Fed's efforts. This situation may be coming to an end. It invokes risks of constrained liquidity conditions with the possibility of an adverse economic shock. For this reason, analysts warn that the second half of 2023 may see excess volatility. Yeah, well, because it does take a while for the interest rates to actually kick in whenever they raise them. Uh, I think it's like 6 months or something like that. So, okay. Backdoor liquidity injections negate the Fed's quantitative tightening. The Fed started its quantitative tightening in April 2022 by increasing the interest rates on its borrowing. The aim was to reduce inflation by constraining the market's liquidity. Its balance sheet sank by $476 billion during this period, which is a positive sign considering the inflation dropped and employment levels stayed healthy. However, during the same time, the US Treasury used its Treasury general accounts to inject liquidity into the market. Typically, the Treasury would sell bonds to raise additional cash to meet its obligations. However, since the national debt was close to its debt ceiling level, the federal department used its cash to fund the deficit. Interesting. Interesting. Okay. Effectively, it's a backdoor liquidity injection. The TGA is a net liability of the Fed's balance sheet. The Treasury had drained 542 million from its TGA account since April 2022 when the Fed began rate hikes. Independent macro analysis Linda Alden told Cointelegraph. U.S. Treasury is drawing down its cash balance to avoid going over the debt ceiling, which is adding liquidity into the system. So the Treasury has been offsetting some of the QT that the Fed's doing. Once the debt ceiling issue gets resolved, the Treasury will be refilling its cash account, which pulls liquidity out of the system. So it's pumping up the economy right now, but it's only a temporary pump that, I mean, will eventually pull off uh so once they allow them to print more money, then it's going to be paid back, so it's going to technically take some money out of the system when they're doing whatever they're doing. So yeah, that's these articles. I hope you enjoyed the news today, and see you next time. Let me